Hello, hello. We are live Sundays with Steadyworth, and this is where we talk about how to use money to design a life that you're actually excited about. I am Laura, a life and leadership coach, and this is Gabe.
Yes, we are excited to be here. Welcome back to another Sundays with Steadyworth.
And today we are talking about investing 101. So this
What
is
an
about,
exciting topic.
yes, we love investing. Investing is what investing in yourself, investing in your finances, investing in your relationships is the single most important thing that you could do to elevate your life, bring more joy, bring more fulfillment, bring more of every good thing. Good things come with investments. And so we're excited to talk about that. Particularly tonight, we're talking about investing your money, but we may stray off into other topics as well, because
Yes.
we've done a lot of investing over the years and have lots of stories to tell. So to kick us off, Gabe,
Let's get going.
what's the biggest myth you hear about investing?
I think one of the biggest myths is, and I think this is also why some people don't want to invest, is the biggest thing that comes up is they say, hey, if I invest, and we're speaking about the stock market specifically, I'm going to lose all of my money. Because that's the biggest thing. They've probably heard some story when someone lost all of their money. And I think, or not, I don't want to say I think, the issue with this one is that it just depends on what you're invested in. I've never heard of anyone who's been in a diversified portfolio or who has been invested in the S&P 500, which is a diversified basket of just companies that are the top 500 largest companies, in the S&P 500. Those have never just gone down to zero. And somebody's like, I was invested in the S&P 500 and I lost all of my money. Somebody who's lost all of their money in the stock market generally has been overly leveraged in one company, and then that company went out of business. So if you may have heard, it was probably about, I think it was in 2000, 2001. I forget exactly. You guys can fact check me. I don't remember, but the company Enron, they went out of business. So if you had, a large portion of your stock portfolio in Enron, when they went to zero, you lost a lot of money. Also, there were several companies that were, valued over valuation during the dot-com bubble in the early 2000s. They weren't worth anything. They went out of business. And so if you have a lot of money in there, you lost a lot of money. I actually have a family member who was a part of a tech company and in the early 2000s, and they had several 100,000 shares of stock in this tech company, and it went from $87. The stock went from $87 to 87 cents. And so, even though they didn't go broke, but I mean, it definitely took a huge hit to their wealth that they had. And so, and it takes time to rebuild when you lose something like that. So I would just say, that's the biggest myth, is that I'm going to lose all my money. And I think that's why, it's really important to just diversify if that's a big concern of yours. And I think that there is also, or I don't think that, if you have a lot of stock, like say if you work in tech, and say maybe like Laura used to work for Salesforce, so she got Salesforce stock. If you work for Apple, you got Apple stock, or Tesla. If when you work at those types of companies, you'll get a lot of their stock. And if you're worried about losing all your money, maybe you want to diversify out of some of that company stock into something else, just in case that company happens to take a hit later on down the line. I mean, Apple's a big company now. We don't know what's going to happen. I mean, back in 2000, everybody wanted a BlackBerry. What if everybody wants a new BlackBerry? I mean, BlackBerry, I heard, is coming out with a new phone, or they're out with the new one, which is what somebody recently told me. I haven't done any research. I still have an iPhone.
I got tired of all the buttons with the BlackBerry. So investing, biggest myth is that people think they're going to lose money
They're going to lose their money. I mean, you can also lose money if you're doing trading and you don't know what you're doing. That's a way. But I will say the main important takeaway is that you can invest in a buy and hold strategy in a diversified portfolio, and it would be very hard for you to lose all of your money. Will your account go up and down? Absolutely. Are there risks? Could we see a market pullback like COVID when that whole thing happened and people's accounts went down by a tremendous amount? Yes. But I can guarantee you, and I can speak on this with authority. I was working at a firm, and so I had access to viewing many people's accounts, several people who had millions and millions of dollars in their account. When COVID happened, all of those accounts pulled back. They were down easy 30, 40, 50%, whatever they were, depending upon what they were invested in. But all of those accounts came back. By the end of 2020, those accounts that not only came back, but were in the green. Nobody lost all of their money. When I was working at that firm, one client lost a ton of money during COVID. And what happened is that when his account went down, he got so keyed into the news is that he was like, you know what? I can't take it. I don't feel like the stock market's ever coming back. Sell all of my stuff. I don't want to do this. Even when we talk, he's like, no, I want to sell it. So he sold his whole account out while it was down. So once you sell it, you lock into a loss. And then when the market took back off, he wasn't sure when he was ready to get back in. And then when he decided to get back in, it had taken all the way back off.
Oh no.
So then he had to buy back in, and stuff was way more expensive than what he sold it at because he locked in that loss, and he was like, no, I can't take it anymore. And
Yeah.
so
And
when you learn a lesson like that, you learn it once and you learn it hard. And that person was in their 60s. And when you get hit with a lesson like that, I mean, several 100,000, possibly maybe in the million loss, and how you get that back.
Yeah. Yeah. So given that, one thing that I am thinking about as well is the lack of education around investing in particular, but also some of these mindsets or beliefs about what investing what it is and what it isn't, and how to actually navigate the stock market. And we're going to dive into that today, but some of those things are coming up for me just as you're speaking, because I feel like you're hitting a lot of different great points. So if someone's never invested before, like let's just say this is the first time they're listening to this, or they don't know very much, they're completely on the low literacy level of investing, what's the first thing you'd want them to understand?
There's a couple of things. If you've never invested before and you're looking to invest, I think one of the first thing is that you should outline what your goals are for this investment, for the investing you're looking to do. So, if you're getting into if the first thing is you're investing into a retirement account, and that could be an IRA, a Roth IRA, a regular IRA, a 401k, 403b, whatever it is through your job. At that point, if it's a retirement account, you're putting money in here that you're not looking at touching until you're at least 59 and a half, or you're going into retirement. If it's not a retirement account, you're putting money into a brokerage account. And so what is the savings goal for this? Is this something that is going to be in here for the next 10, 15, 20 years? Is this something you're trying to put in here to get a house? So I feel like every investment we get into, we should have an entry point and an exit point. And maybe that exit point is forever. So, I mean, I have some positions that I'm holding in my portfolio that I'm like, I'm never planning on selling these. Like I'm planning on holding this position so long that in being that I'm able to have grandkids, they're going to get it. That's my plan for this. Whereas, I could have another position where I'm like, hey, I'm going to sell that to go buy a house, or I'm going to sell that to fund this thing or that thing. So I think knowing your starting and exit point, like what is the point of why you're doing the investment? Because if you don't really have a point for it, then we can't really gauge is what we're doing, is it going to be successful or not? The next thing I would say is to understand what your risk tolerance is. And so that's how much risk, because when you invest, of course, there is risk. It has ups and downs. And so if you have a short-term goal, maybe you're saving for a wedding in the next 12 to 18 months, you may not want to have all of that money or much of it possibly in the stock market, because it can run up really quick, or it can be like what just happened on Friday and we have a 5% pullback and it go down really quick. And we don't know when that type of stuff is going to happen. I mean, we can guess, but we don't know. And so understanding your risk tolerance, and that risk tolerance, basically you're able to understand when you have your risk tolerance keyed in, you're basically kind of able to maybe work through a simulator of what type of fluctuation you can handle your money having. So if you put $10,000 in, and then over a course of time, it grows up to 12,000, but then also over a course of time, it pulls down to 8,500, how would you feel? It's with the thought that it can go back up to 12,000, it could go to 13, but it could go to 7 as well, depending on how you're invested. And so knowing, what level of fluctuation and what your risk tolerance is very important. Earlier this year in April, we had an event called Black Monday when everything was going on with the tariffs and all of this stuff, and the market had a major pullback. And so I remember this one company that I have their stock. I went from being like $60 a share to $35 a share. And so, if you have several thousand of those shares, then you're all of a sudden your portfolio is down several $1,000s.
Yeah.
And everything was down several thousand. I mean, all the stocks across the board were down. So it's just like, what level of fluctuation can you handle? Now, did all of them come back? Absolutely. But there is no guarantee when it goes down how long it will take for it to come back. And sometimes it can feel like forever when you're waiting for it, especially if you need the money.
Yeah, I'm just gonna pause really quick. Shout out to Ken. Ken's joining us this week.
Ken, what's going on, man?
Here. Good morning to you. Happy Monday for you, Money Monday. So it sounds like for a starter investor, there's kind of three main points that you're talking about. One, get clear on what it is, what goal you have in mind, and the time horizon for that goal, right?
Absolutely.
Is it a long-term goal? Is it a mid? Is it a short-term goal? Then the second piece was around assessing your risk tolerance.
Yes.
So really understanding what level of risk you're comfortable with and how you can kind of navigate the ups and downs of the market that naturally happen when you have your money invested.
Right.
Okay, cool. I think that was three. The goal itself, how long you want it to be in there, and then the risk tolerance. Did I miss something?
I don't think so. I think it was maybe two: the goal itself, the risk tolerance.
Okay.
In the time.
And the time horizon. Yeah. Like the time
goal
horizon.
Itself, risk tolerance, time horizon. Yeah.
That's right. Okay. So if you're a beginner, those are kind of some of the things you want to think through. Like, what is it that I'm trying to do? A lot of first time investors that we run across, like, I just want to
make money.
I just want to learn. Like, so I feel like we have a lot of clients who are very hesitant. Like, they don't know enough about it or how to even execute the different things, that they just feel nervous and unsure. And so it's like, we get really clear on their goals first, obviously, what they're trying to use the money for. I think that was the third one, what they're actually trying to use the money for. Yeah. Like, do I want to keep this long-term and hold it forever and never let it go? Do I want to invest this so I can buy a house in 5 years, et cetera? Like,
right. And I just want to interject and say, there's a couple things you can do if you're really nervous about getting started in the stock market. One is that you can just track a stock and say, okay, you can give yourself say, okay, I'm going to give myself a $10,000 fictional credit. Like, this just doesn't exist. And I'm going to go buy $10,000 worth of whatever, whether it's mutual funds, an ETF, which will explain what that is, a stock, a bond fund, whatever it is. And then you just track this stuff. You buy it, you write it down, what you bought, what day you paid for it. And then maybe you just track it for a couple months. Did you make money on what you bought? Did it go down? What are the percentages? And so then that's one way of just having stock exposure with just a fake account. We actually did this in my econ class back when I was a senior in high school. I remember I bought GM stock. I wanted, GM. I was in NASCAR and all I had this NASCAR jacket and stuff. And so I remember a buddy of mine, he bought Lockheed Martin stock because that makes the fighter jets. And, he wanted to be an engineer. And so, but we were in each Monday, we had to this was back before smartphones. I'm aging myself. So I had to get on the computer. And this is back when there wasn't a bunch of websites. I would look up what the stock was. I would print out, what the share price was. And I would bring it to school that day. If you didn't want to do that, you could also look it up in the newspaper. Yes. Back then there were newspapers, printed newspapers. And
with
so
all the stock prices, that's wild.
Yes, with the stock prices. And so, so, I mean, of course, now you can just track it on your phone.
You have less ability to be super anxious back then because you weren't watching
right. Yeah.
all through the day.
You weren't getting crazy updates nonstop. But so, so that's one way. If you just create, you give yourself a fictional credit and just invest in some things and then just track it and see how it does. Yeah, maybe it doesn't sound exciting, but if you want to understand how the stock market works and guarantee that you won't technically lose any money, that's one guaranteed way, because you haven't invested any money. You just bought it on that day and you're just tracking and seeing what it does. Another way, you know, that I talk to people about getting invested, and this is putting a little bit of skin in the game. And you may have seen, if you've seen our YouTube channel, we have another where I talk about the DAD investing strategy, which stands for $1 a day it's $1 a day, where I'm buying a fractional share of an ETF, which stands for an exchange traded fund. And I buy SCHB, which is a Charles Schwab broad market fund. I've been buying $1 a day on that. I started July 1st, 2024. So this has been going on for just over 13 months now, since it's now August 4th. And and so each day it buys $1 Monday through Friday. And then on Friday, I actually make an additional $2 buy. So a total of $3 on Friday, because it buys for Saturday and Sunday. I don't buy for the holidays. So 4th of July, Memorial Day, Labor Day, Christmas, Thanksgiving. I don't put in extra money for that. But I've just been tracking and it's up about 7% on the year. I mean, it's had times when it's been down and it has times when it's up. We have a couple YouTube videos that go over the exact strategy, but it's showing you, hey, this is what it looks like if you just have $1 going into the stock market every day. And so that's another way that you could do it. If you wanted to test it out, you wanted to put some skin in the game, you can buy a fractional share of, I'm buying a Schwab broad market fund, which is SCHB, but on a platform like Robinhood, they offer hundreds, if not thousands, I think thousands of different stocks that you can get fractional shares of. I mean, it's almost everything. And so, that's another way that you could get started, buy a couple fractional shares and then just track what's going on.
And one thing I would add to that, to the person who really doesn't want to risk anything to learn, is it's very hard to learn if you don't put yourself out there and you don't invest something, because you don't have a stake in the game, right? It's like, I always think about when you've bought something yourself versus when someone buys, when your parents used to buy stuff for you, or, someone, you get a gift, like, depending on what it is and depending on, how big the asset is, sometimes when you pay for it yourself, you have a little bit more.
Oh yeah. It means way more when you pay for it for yourself.
Well, we have a friend that Gabe is mentoring right now in the investing game, and he bought himself a car that he really wants and loves, and he takes care of that car. It's always in pristine condition, it's always washed, it's always clean, it's always got all that stuff going on. So, when you're starting out investing, I think, you do have to have a little bit of a stake in the game in order to really learn. And because a lot of times the best learning comes from your mistakes, not necessarily your wins. So I think the $1 a day is something that can be really safe to start off and just see. But I would encourage a starter to really challenge themselves to invest a little bit more. I know that Gabe, when he first started investing, he wished he would have started sooner.
Sooner and more money. Yeah, my two things I can say about investing is, I wish I would have started sooner in life, and I wish I would have spent more money. I wish I would have just went in and put more money in, 1,000%. Those are two things, more and more often.
We talk about this all the time. I didn't know anything about investing at all. My parents are not necessarily investors. They've been really great investing in real estate, and that's worked out for them. But in terms of the stock market, it has not been a thing. So I procrastinated that. And that is one thing that I still kick myself over. Man, I just wish I would have set up that paperwork, put in the investments, and just, set it and forget it. But, okay, I'm going to keep us trucking along here.
Let's go.
So what is the difference between saving and investing?
That's a great question. So, and I think this is what confuses people a lot when they think, oh, I'm creating wealth. Like, you can't create wealth by saving. You can save money, but I want to give it to you to think about like this. Let's say from 20 years ago, you saved $100,000. And right now you still have that same $100,000 that you got. Let's say somebody gave you $100,000 on the day that you graduated from high school, however long that was. For me, that's been a little bit over 20 years. If I had to just save that money in my bank account, it would be worth a lot less than it was when they gave it to me, because back when I graduated high school in the early 2000s, $100,000 could buy a lot more than what it could buy right now. So I've technically lost money. Now, if somebody had to get 20 years ago, had to take in $50,000 or even less and just invested into the S&P 500, right now today, it will be worth several $100,000. So saving is just accumulating money and holding it there. Whereas investing is putting your money to work and giving your money a job and actually putting it out there so that it can start growing for you. And that's how you really create wealth. People who are creating wealth has their money making money. When you think about somebody who's really wealthy, somebody like Elon Musk, Warren Buffett, Jeff Bezos, Bill Gates, Mark Zuckerberg, their money is making money. They're not just saving.
So just to kind of like put the drive the nail in on this point, on average, the S&P 500 over the course of a year returns anywhere from 7% to 10%.
They say like over the course of 10 years, it's like an average of 10%.
I'm just talking about 1 year. But
yeah, but I mean, each year can be different. So, because you can have a year when it's down and you can have, a year when it's up. But I mean, over the last 15 years, it's been up more than it's been down.
Okay. And so if someone were to just if we were to just nerd out for a second, would we compare that with the inflation rate over the last 10 years? To see how much money someone might have lost in value?
Yeah, I mean, you could. I mean, like we once give this example about if we had, $25,000, we were doing a math equation the other day. It's like, what would $25,000 in 2009, if you invested in the S&P 500, be worth in 2021? And I think what the calculation we ran is that it would grow at 13%. S&P 500 over the course of that time averaged about 13%. And so if we put it into like a income calculator, so $25,000 as a one-time investment in 2009, and you pulled it out in 2021, I think it turned into about $127,000. And so what's that, 5 times itself?
Yeah. And that was no further
that's the power of putting money to work.
Yeah. And so I was just thinking to really just paint the picture of what inflation will do.
Right. And so I mean, inflation, some people say it could be up to 3% a year. I mean, right now, this year, they've said that the dollar has lost 10% of its buying power from the beginning of the year to now. So if you have $100, which actually I do have $100 in my wallet right now, that means that I only can buy $90 worth of goods that I could have bought in January with this same $100 bill, even though it's a $100 bill. And as you know, that $100 bill in this one isn't from 10 years ago, but 10 years ago, it could buy me a whole lot more than what it can now. Right. I mean, when we go to the store, $100 is almost like a half a bag of groceries, depending on what you're buying. It doesn't go as far as it used to. Whereas I could think so many times back when $100, I mean, I remember when I was a kid and I worked a job and I got $100, I'm like, yo, that would
last me. I mean, even in, I was working in Hilton Head, South Carolina in 2012, and I was making about $100 in a day working, in tips on this boat. And that would last me like 2 weeks.
Yeah. I mean,
and that's like me. I mean, of course I'm younger. I'm not paying all these. I didn't have like a laundry list of bills, but in terms of just like everyday necessities, it lasted me a while. So,
right. Yeah. I mean, depending on what car you drive, I mean, $100 can be a tank of gas now.
That's right. So the difference between savings is just putting money away in a bank account and letting it sit there.
Or wherever you're putting it at. Whereas investing is putting your money into different vehicles that's causing it to grow.
Okay. So let's talk about what some of those vehicles are.
Sure.
And what that looks like. So I think the common ones that we talk about or that people hear about are stocks, bonds, mutual funds, ETFs, and as of late, you've been on a Bitcoin.
Yeah. So stock. So I think when you think of a stock, I think you should think of ownership of a company. So anytime you buy a stock, you're buying a fractional piece of ownership into a company. So a stock is an owner. So if that company does well, the stock goes up. As an owner, you make more money. If the company doesn't do well, the stock goes down. And as an owner, you don't make more money or you possibly lose money. A bond, so stocks are owners. Everybody who owns stock owns some sort of ownership. A bond, I like to say, a stock's owners and bonds are loaners. So when you have a bond, you're loaning a company or a is it municipality? Is that how you say it? It's like a city.
Yeah.
Yeah.
Yes. Yes.
Yeah, so there's like companies, municipalities, governments who have bonds. And so what they're saying is like, hey, they'll they'll come up with these certificates, and then they'll say, hey, this is $1,000 bond certificate. You give us $1,000, we'll give you the certificate. We'll pay you interest on your $1,000. So let's say it's a 10-year bond that pays 5% interest. You give them your $1,000, they'll pay you 5% interest every year over the course of the 10 years. So it'd be $50 every year over the course of the 10 years. And then at the end of the 10 years, they give you your $1,000 back. So a bond is a loan. So they're able to take that money that you give them. Hopefully they're able to put it to work and make more money with it, also while they're paying you interest, and then they pay you back. And the reason why some companies do this is that when they sell bonds, that allows them to raise money without diluting ownership, because every time they release more stock out into the world or into the market, they have to that stock has to come from somewhere. So they have to dilute some ownership. Whereas a bond, you don't have to dilute any ownership because you're just taking a loan. You're borrowing money from someone, you're paying them interest on it, and you're giving them back. Whereas when you give out stock, now you have other owners in the company and so forth. So that's stocks, bonds. When you think of a mutual fund is a fund that's made up. It could be made up of multiple different types of stocks and bonds, or it could be made up of just a particular type. So different mutual funds specialize in different things. So it could be a broad market, whereas, a bunch of different companies in there, or it could be one that's just specifically focused on finance companies or tech companies. Same thing with the ETF and exchange traded fund. Now, mutual exchange traded funds trade more like stocks, whereas you can get in and out of them in the same day. Mutual funds have a different type of calculation. So they have a different type of way of being taxed, and getting in and out of them takes a few more days. But in theory, they kind of work the same. The big thing to know is that if mutual funds, I personally find better in retirement accounts because of how they're taxed, whereas an ETF would be better in a taxable account. This is more technical. Once again, this is not financial advice. You should talk to your tax account, your CPA, if you if you have specific questions about your situation. These are just this is all my opinion, and is for entertainment and educational purposes only. Do with it what you may. And so, but this isn't for anyone. I'm just telling, this is how I do it. So I've had mutual funds inside of my retirement accounts. I use ETFs inside of my taxable accounts, which is like a traditional brokerage account. So that's stocks, and they can be made up. You can have mutual funds that have stock or ETFs with both stocks and bonds in them. Crypto is another form. Crypto is when we're specifically Bitcoin, which we did a Sundays on Steadyworth on Bitcoin. It is a form of a money. It's like digital gold.
Digital asset, right?
Yeah, it's a digital asset, and some people equate it to digital gold. And this is, I have money in there. I like the idea of buying Bitcoin, and it's not a stock, it's not a bond. So you don't get, when you buy it, it's just, when you acquire it, it's the same thing as like acquiring, like if you, any other type of currency, like if you got a dollar or a yen or a pound or a euro. And so it's not related to an underlying company, like how a stock or a bond or underlying, it's not even related to an underlying government, like how other currencies would be. Yeah. But and I won't go off on, we won't make this whole situation about Bitcoin, but
if you're interested in learning more about
we
Bitcoin,
did a full live on it.
Videos.
Yeah, we have a couple videos on it. Feel free. And so, that could be another investment vehicle. And the reason why I would call it I would just say this: the reason why I would call it an investment vehicle is because the price of it is continuing to rise. Whereas let's just say I have a house and I sell the house and I keep all the money in US dollars. Well, each year the dollar isn't getting any stronger. Each year the dollar has, over the course of at least the last 50, 60 years, ever since we've come off the gold standard, the dollar has gotten weaker. It's not, you're not buying more things with dollars. You're not buying more things with dollars. You're buying less. And so that's why we are constantly, when you look at how much stuff costs in the real estate, did real estate prices really go up, or did the dollar just get weaker and it's taking more dollars to buy it? And so one thing about Bitcoin is that since it can't be what they would call debased, or you can't print more money, more of it, anything that you can't make more of, it has a scarcity factor, which makes it more of what we will call a hard money. And so it is able to retain its value, such as gold. Gold, you can't print more of it, and it costs a whole bunch of it costs a lot of time and money to mine it. That's why it's able to retain value. When you think about US dollars, the money that we have in our pocket, or pounds, or any of this money, this is just paper money that's created by a government, multiple governments, and they've said that it's valuable, but they can create it faster than we can work for it. In 1 year, you may have a job. Most of you, hopefully, I hope you all have jobs and are able to make money. But let's just say, you know, the average person in the US, I don't know how much they make, 50,000, 60,000. Let's say you have a great job. You make 100, 120. Let's say you make 300,000, 500,000. You're in the top 1% if you make 500,000. But it takes you all year to make 500,000. The government, with just a couple votes and the touch of one button, can print out millions and billions and trillions. Matter of fact, they don't print millions anymore. They only print billions and trillion, billions at a time, and send it out in a matter of minutes. They hit a button and they print more money than you can make in a whole lifetime. And so that's what makes our money weaker. And that's what makes Bitcoin more valuable, because you can't print any more of it. And so that is the little spiel on that from an investment perspective.
This, for me right here, when I hear this, I can easily go down a rabbit hole and feel slightly discouraged when I hear things like this. And also, this creates a level of urgency around the investing conversation and the investing skill, because you have to be able to have your money grow without having to work exponentially 10 times harder to make 10 times more. And so there is an old mindset that kind of needs to be let go of. Right now, we believe that we can go to work, earn an income, and survive and retire, and everything will be fine. And I hate to say it, but this idea is this concept, or this reality, is kind of dead when you hear this, because they're not, back even 20, 30 years, they weren't printing as much as they are now. And so being creative, understanding investing as a skill, making this a common part of the curriculum of your learning and what you're doing in your everyday life is vitally important for you to just keep up, period.
Are you able to share a screen?
I can. What would you like me to share?
I was going to say, and one thing I was going to say is that I want you to bring up that article that I emailed, that I sent you. It's in our text thread. I sent it to you yesterday. I just brought it up. But, and this is the reason why, one of the most important reasons why we have to invest is because our money is being debased, and the government is printing money. And so we're losing money every day while it sits in our bank account. And we can't, since it's not tied to a gold standard, the money we have really doesn't have any value. So it's like we're working for it, but we're working for our money, but it's constantly losing value. So it's like when you have fiat currency, which is government money, you want to make sure that it's in something that's actually growing, so that your money's keeping pace with inflation and with all of the other money that's currency that's coming into the system. That's why it's really so important to invest, and so I wanted to bring up this article.
I was finding it. Give me 1 second. I got it.
I have it right here, but I don't think I can share from my side.
Yeah, I got it. Here we go. Okay. Can you see?
And so when you scroll down a little bit, I'm just going to read this. It says, many Americans dream of retiring with the $1 million nest egg. Americans in general think they need about 1.5 million to retire, but in the reality is is starkly different. And then I think it's only, I'm skipping down, only about 2.5% of all Americans actually have 1 million or more saved in their retirement account. 2.5%. How many people are in this country? That's like 330 million or something like that.
I think there's more than a million. There's more than a million
No, I said 330 million.
in this country. I don't know. We'll have to
Yeah,
look.
but I'm saying, but it's saying 2.5%.
Right. That's not a lot of people.
2.5%. Among actual retirees, only 3.2% have reached the 1 million threshold. So it's saying only about 2.5% of Americans actually have 1 million or more saved in their retirement accounts. Now, I have found there's several people who are millionaires by retirement, but once again, they have that money maybe locked up in equity in their house. But to access that, you either have to sell your house and move to a state that's much cheaper, which is starting to get thinner and thinner these days,
Right.
depending on where you're coming from. And
Right.
then, or you have to take a home equity line of credit or a HELOC where you're actually pulling, like a reverse mortgage, not a HELOC, but a reverse mortgage where you're actually, you have a banking, an investment product that's actually allowing you to pull money, equity out your home, and then they get your house when you pass away, or you basically, your heirs have to pay off the reverse mortgage in order to keep it. So, this is the importance of getting started investing early, is that you have more money. Yeah. So, I mean, just seeing, this is just an article that came up. It was on my feed in Apple News, and I just clicked on it, and I was just like, man, when you read some of this, it is sad when you think people work in their lives. Say if the average person, let's just push it out. Say you get a decent job at 25 and you work for 40 years from 25 to 65, and you still don't even have enough money to retire. And that's part of the financial education problem that we are trying to help solve here at Steadyworth. It's like, how is that happening? You've worked for 40 years and then basically you need to keep working.
Right. Yeah.
Yeah. According to Fed data, just over half of Americans, 54.3%, have a retirement account. And of those, less than 1 in 20, 4.7% have reached one. Yeah. It's just crazy. Yeah, so it's saying the median retirement savings for a household led by someone between 65 and 74 years old is $200,000, dropping to 130 for those 75 or older. So let's just keep this in mind. Like, think about this. Like, even if you're living, even if you're living in like an average lifestyle, it's like, most people are probably needing to go through about, I would say, probably 50,000, 50. This is on a light level, 50 to 60 probably to survive. I mean, that's paying where you live at, your utilities. This isn't vacation. This is food, transportation, communication, all of that stuff. I think that's costing the average person, I would say, probably 50 to 60 a year, because keep in mind, when you pull in this money out of their retirement account, you're getting taxed on this too. This isn't tax-free money unless it's in a Roth. And so if this is just in your 401k at your job, so if you have $200,000 in there and it costs you 60 to live, I mean, 3 times 60 is 180. And so you got 3.2 years. Like, that's rough. I mean, and let's give you 5 years because you get a little bit of Social Security. Still, like, we got to do better. We got to progress this financial education. We got to do better.
Yeah, we got to do better and really get rid of this myth that you're going to lose money in the stock market, because anyone who has a 401k, I think what people don't understand is that if you have a 401k, your 401k is invested in the stock market. Your company is investing in the stock market for you.
Right. Or if you work for a publicly traded company, like, that company is in the stock market itself. You know what I mean?
Right.
Like, if you work for, Apple or Salesforce or whatever, it's like, yeah, you're the whole company, the whole thing is, it's like, it's basing its valuation, its investors are on the stock market. Like, get some positive gains from the company you're working for.
Well, and one way I like to think about the stock market in particular is like, it's your way of being a business owner without doing all of the work of a business owner, because
Right.
you're not
Absolutely.
necessarily in charge of making the decisions. Of course, I think you want to, of course, you want to invest in companies that you respect and that you like the decisions that they're making and you feel comfortable with the decisions they're making. That's like investing 201, 301, getting to that place. But you're technically a business owner without being a business owner. So
Right.
you're reaping the revenue and the income without having to sit down and make all the decisions or detail out the marketing plan or doing all this stuff. And so why wouldn't you want to own a company that's going to make you money without you having to think about it?
Absolutely.
And I think that's a big shift for a lot of people. And the more you can learn about it, the more you can understand how companies operate, the more you can understand how the stock market operates, the more comfortable you'll get putting your money in there, and the more money you will end up putting in there. And then the less you'll have to work on the back end. And I do feel like there needs to be a mental shift from an old way of doing things and an old way of thinking about how we earn money and how we save money to I have to be investing in myself and in my time and in my money in order to continue to grow and keep pace with how things are changing so rapidly. So
That's right. And
if
you
you get
can have
nothing else out of this live.
right. Yes. And also, you can have a regular job, like, and not that I should have looked this statistic up. It's in this book behind me, The Psychology of Money. But when the book opens up and it's talking about a guy who worked as a janitor.
Oh
So
yeah.
janitors aren't high paying jobs. But when he passed away, he had over an $8 million net worth because he was regularly investing his money. And so the thing is, it's not about how much money you make, it's how much money you save and invest. So you can have a average job living below your means, saving your money, investing, and be making and have a lot more net worth than somebody who's making $500,000 a year,
That's
who's
right.
living at their means, driving a brand new car, having multiple houses, taking a ton of vacations. But that doesn't mean anything if they're not putting any money up and invest in starting to grow their wealth. They're going to
Yeah.
get to retirement and be just like one of the people on the statistics survey, because this survey isn't talking about income. It's talking about who's invested.
Yeah. And
And we're
who's
at
going
a
to be
point
able
now,
to live
it's
off.
not an income thing. It's about who's investing.
And you have to, I mean, think about your retirement as what you're going to live off. Like the money that you have saved is what you're going to live off for the rest of your life. So
Yeah.
unfortunately, if you don't have very much in there, you have to have a very hard conversation with yourself. And it's better to have those conversations early when you have more time.
Yes.
um,
So what's our next one?
our
As we
next,
wind in.
our next place that we kind of want to dive into, I think the next thing that kind of people talk about a lot is, and we talked about it earlier in the episode as well, is around risk tolerance. Like, how does someone even figure out what their risk tolerance is and how comfortable they are investing?
Well, I'm not going to take too much time on this one. I think the best thing to do is what we're going to do is we're going to post a free, there's like a risk tolerance questionnaire.
Yeah,
So
we'll
I
find
think
it.
we get it on the Charles Schwab website, and we're going to post it in the link below, and you can just click on there and just take it. It'll probably take you about maybe 5-10 minutes. It just asks you several questions, and it helps you come up with what your risk tolerance would be, meaning what would be your split between stocks and bonds. And then you can even work in, if you want to get some crypto in there. This one specifically, if it's on Charles Schwab, won't tell you how much crypto to add in, but but this would be a good place, I would say, to get started, is to take a risk tolerance questionnaire, and it will ask you several great questions. We'll post it in the show notes so that you can just get started.
And I just dropped it in the comments as well, just in case someone wants to click on it now and save the tab. But this goes back to what we started the episode with too as well. It's going to help you understand your time horizon and some of the things about how you feel about when things go down, when you need to withdraw it. A couple of other questions. And it will basically help you kind of understand like what your annual average rate of return might be given your risk tolerance, given your bet, like what your best year would look like, what the worst year would look like, and then kind of you can respond and react to that. And it is kind of a more emotional response, right? And so you want to see how comfortable you feel with that and make sure that you're going forward with a strong decision, or you feel clear at least on what your decision is as well. Okay, so I'm going to skip over to, since we're coming close to the end here, if anyone has any questions at any point, please feel free to drop them in the chat. We will definitely answer them. Thanks so much for being here. If you haven't already, drop your name and where you're joining us from. That would be great. So if someone has $100 or $1,000 to start, what would you recommend they do with it?
I'm guessing that as I answer this question, once again, this isn't financial advice. This is for education and entertainment purposes only. I want to make that very clear. And if you have $100,000 or if you have $100 or $1,000, when you're investing it in the stock market, there is risk, and depending on how you do it, you could lose your money. So I just want to make sure you know all that. And so I don't want anybody saying, "Oh, he said this," and so I just want to be clear. And so I would say, if you're looking to get going, there are some great apps. One app that I talk about a lot on this platform is the Robinhood app. They don't pay me to talk about this on their platform, but we're also going to put a link below that if you would like to open up a Robinhood account and you don't have one, click on our link. When you do that, we get a gift. It's like a $5 share of stock, and you'll also get a $5 share of stock for using our link. But I want to say that on this platform, if you can use a platform like this, if you have $100, if you want to buy fractional shares, you could literally get into multiple companies with fractional shares of stocks if you were looking to buy whole stocks. Also, if you're looking to buy ETFs, exchange traded funds, there are several exchange traded funds that you can buy whole shares. Like I was saying, I like several of the Charles Schwab ETFs. The SCHB one that I buy, it's about $24 a share. There's a SCHX. That's a good one. There's SCHD, which is a dividend fund. Once again, I'm not saying that you should buy these. I'm just giving examples of ones. The reason why I'm giving examples of the Charles Schwab ones, because all of those funds are about in the $20 range. And so if you have $100, you could easily buy a couple of those. And now there are other funds that are the equivalent of those. Like Vanguard has some very popular funds like VOO, VTI, and some of these Schwab funds are the equivalent of those, but different. But the reason why these Schwab funds, like they were trading at like 60 something dollars, several of these were trading at 60 or 70 something dollars a share last year. And Schwab actually did a stock split, so for every one share they did a 3-to-1. And the reason why they did that is for people who have smaller accounts who want to be able to buy a whole share of one of these stocks, or can now able to buy one for a cheaper price. And so and I think that's something that I would like to encourage someone to look at, is that when you're looking to invest, you want to look at the fund size. As of course you want to look at the track record, but when you look at the fund size, so because it's like, if I'm investing into a fund, that if I have $1,000 and I buy this share in this fund, but it costs $400 a share, where I can only buy two. And sometimes you can't buy depending on what platform, you may not let you buy a fractional share you're on. And then if you have, say you get $40 and you're trying to get back in, you want to put that money to work, you have to wait till you save enough money to get $400 again. Whereas if you're in a smaller fund, you can keep buying back in, and the buyback end isn't as much. And so I think that it can make sense comparing some of these funds, that as you go through the risk tolerance questionnaire. The great thing is, if you open up an account on Robinhood, they have this, Charles Schwab has this, Fidelity has this. You can go through what they call like an ETF portfolio builder, and they will actually recommend different funds to you, and you can compare them all using Yahoo Finance.
And this is based on your risk tolerance.
Yeah, you can. After what you do your risk tolerance, they have a portfolio builder, and you can go through there, and they'll say, hey, okay, according to this, you might want this percentage in large cap, and this is how many large cap funds. Here's 5 different large cap funds to compare from. This many in mid cap, this many in small cap, this many in international or whatever, and the different types of bond funds. And so they'll give you a bunch of different options, and you can go on and look them up. I would say, if you're getting started, put them all in Chat GPT and say, hey, here's 5 different funds. What's the make me a graph and tell me what's all the difference between all 5 of these funds. So if you're getting started and you have no idea, that might be a great place to start with. And so But these different types of platforms like Robinhood, Charles Schwab, Fidelity, Vanguard can help you craft an investment account depending on your budget. But if it were $100, I would say probably your best bet is probably going to be something like a Robinhood, because I feel like it's more so designed for somebody who has maybe a smaller account.
Smaller
And
budget.
even though they've grown their platform, so now people who have much bigger accounts are on there as well. But it might be very easy. I mean, you could definitely with $100 open an account at Charles Schwab. Yeah, but they generally
Probably would
don't
be
allow you to do fractional shares with stock though, that I've seen.
right. So you wouldn't be able to use your entire $100 all at one time.
Right. For the most part, whereas
Depending.
a Robinhood would allow you to do fractional shares. And so that's why I was like, if you just had if you were starting with 100, Robinhood might be the best place. And I mean, I have accounts at multiple different brokerages for multiple different reasons.
Right.
You know, just because you start with one, I would say, the most important thing is to start, because 20 years ago, or maybe more than 20, because 20 years ago was 2005. But let's just say 30 years ago, which was be 1995 and maybe a little bit long, in the early 90s, you had to have a person who was a stockbroker go in and buy your stocks for you. You couldn't just get on this thing
That's
called your
wild.
phone and go on an app like Robinhood or Charles Schwab and buy stocks. And so, you had to have a connection, have a broker. A lot of times these brokers had a minimum and they're charging you fees buying this stuff. And so I think the great thing about an app like Robinhood is that the same conversation that somebody who's making 500,000 a year, 10 million a year is having with their child around money. And they're like, hey, we just went in and bought however many hundreds shares of XYZ stock. The person who just has a regular job and only has $100 invest can go buy a fractional share of that same stock on an app like Robinhood and be having the same conversation with their kid. They just did it, and it's on a smaller level, but they're still participating in the conversation. They're still in the arena. There's like, hey, we still have ownership. It's just it's a smaller bit of a share, but we're still having this ownership. We're still tracking this and connecting this to our wealth. Whereas before, if you didn't have the money, you just were locked out. You couldn't get in the game.
Yeah. And we talk about this all the time, and we don't really have an access problem anymore. We have an application problem. We have a lot of people who have access to all these tools and all these great things to build wealth with no idea how to apply any of the principles, have no understanding, no education. And so that's really, we're still in that shift of a mindset where I have to be rich in order to invest because I need a stockbroker, when really you don't need to be rich in order to invest, because almost everyone, I've seen homeless people with cell phones.
Right. Yeah.
Has a cell phone and an app.
Yeah. It was about a year ago. I was outside and the guy asked me, he's like, hey man, you got $1? And I was like, man, I don't keep cash on me. He's like, well, okay, can you shoot me a cash app?
Right.
Right.
Yeah. So it's like access is no longer our problem. Application is our problem. And in order to apply something well, you need to have the knowledge and you need to have the understanding. And so there is no gap between rich and poor now. Anyone can invest. Anyone can put their money in. It does not matter how much you have. Like Gabe said, we have a video on here where he's buying $1 of stock a day. So if that's all you've got, start doing it.
That is the power of the stock market. When you think about it, with $1, you can get in on the stock market. With $1, you can get in on you can buy a fractional share of a Bitcoin with or any other cryptocurrency with $1. Where can you buy a fractional share of a piece of real estate for $1? You can't get in on any real estate deals for no dollar. Nobody's letting you in on that. You will not be joining that conversation.
Right.
And so this is something that's, and the same thing about when you get on the stock market, even if we're talking about diversity and inclusion, it does not care what color you are.
Right.
You got $1, you can get in there. Nobody even knows on the other side of the computer screen. You can show up in a neighborhood and somebody may not want you in their neighborhood, but you show up at the stock market, you got money, you got $1, you in there.
Yeah, that's right.
So that is one of the things, whereas the barriers are not there.
Yeah.
If you want to get on all the Robinhood app, Charles Schwab, they also have, it's not the end all be all, but they do have some educational stuff on there where it explains basic financial concepts as well. So you can get on there and actually start learning as well. These apps do provide education as well. I mean, of course, you're going to need to do some outside education, watch a YouTube video like the one you're watching here. We have
Right.
other great ones on the Steadyworth channel as well. Probably read a couple books, maybe some audio books or something like that. But you can easily get started and get down this investing journey with
There's
as little as
really,
$1.
there's really no excuses, because you are literally teaching yourself something financially right now with ChatGPT. Like, there are so many people out there. You have access to all these different content creators who are specializing in financial education, and the tools are no longer a barrier. And so, like Gabe said,
And yeah, and I just and one thing I would say too is, you know, when you're listening on to content creation on YouTube, especially around finance, and you don't know what's right for you. So one thing I've been doing, excuse me, is I'm teaching myself how to trade. I wanted to learn how to trade, but I don't which traders are legit on YouTube and which traders are not, because there's tons of them. So what I'm doing is that I just look up different trading stuff and I watch it, and I have a couple different ones and I'm watching their content. Then I'm comparing what I'm learning and what each person is talking to see which one is resonating with me. And I think that's the same thing I would encourage other people to do. When you get on the YouTube channel, you're like, well, this person is saying you need a budget. This person is saying you need life insurance. This person is saying you need this. This person is saying you need that. You know, the thing is, since you're getting free content, what you're going to have to spend is your time. So invest some time into watching multiple videos by multiple people and then see which ones resonate with you.
And the one caution I would make about YouTube and free content on social media is that you can label yourself a money expert and not be a money expert. People call themselves financial advisors because they don't want to say that they're life insurance salesmen.
Right. And I think it's also great if you see what type of credentials they have. I mean, here I'm a CFP. You can look me up on the CFP board. I have my CFP ID. And, you know, when you're a certified financial planner, I mean, that's the gold standard for financial planning. I've worked on getting that designation for 3 years. I had to sit under another CFP for 6,000 hours, take a test that's only offered 3 times a year, take 6 classes before I can even take that test, do all kinds of things. I'm not saying this to toot my horn, but I'm just telling you, this wasn't one day where I just got stood up and said, hey, I'm going to be a financial expert. And the thing is, even as a CFP, I just feel like the CFP is just the basis for becoming an expert in finance. Because when you're going through the CFP, it talks about insurance, estate planning, investing, taxes, all of this stuff. And then from there, as you start your career, it's up to you to build on all that stuff to keep retaining your value and keep building your value each year. So each year I'm still focusing on learning more and more and more and more so that I can serve the people that come to Steadyworth, and that I can serve you all here on this YouTube channel. And so I think that it's really important to see, you know, what type of credentials, what type of experience does this person have?
Well, and I'm not just saying this because you're my husband and I think you're awesome.
Well, I hope so.
But the more, and you know, like I've said before, I'm not trained up in the way of personal finance. So I don't claim that as an expert, even though Gabe gets upset with me because I know more than the average person, mostly because I'm married to a CFP and I've learned a lot by sitting in the seat. But there are so many levels and layers to building financial freedom and wealth. And it's really important that you understand where you are on the levels and apply strategies for that level and not get ahead of yourself. And I think the one thing about, and this is a small rant on social media, is it's very hard for you to interpret on your own what level you're on and what type of advice you're getting from this YouTuber who's saying you should do X, Y, and Z, right? You should have a whole life policy because of X, Y, and Z reasons, this, that, and the other thing. Maybe that's true for someone on level 50, but it might not be true for someone on level 2, which is where you're at. And so,
not saying you're on level 2. You could
not saying that you're on level 2. You could be on level 50, and that's totally fine.
Right.
But I think it's really important to kind of make sure that you understand where you are, where you're trying to go, and what strategies make sense for you given where you're at, because a lot of people can get into trouble listening to this type of advice and not really understanding how to apply it. Again, we do not have an access problem. We have an application problem.
And one thing, I just want to, in that thing, I just want to say that when you're working with somebody in finance, a finance coach or something like that, or anybody, a financial advisor, you always want to ask them, how are they compensated? Because if you understand how they compensated, it's always going to lead back to what it is that they're trying to sell you. You know, if they're selling life insurance, if they're compensated through commission on life insurance, they're going to be selling you a life insurance policy. If they're compensated on mutual funds, you know, by getting you to invest in this fund, they're going to be selling you a fund, which is probably like maybe somebody you might talk to if you go into a bank or something like that, maybe a Fidelity office or Edward Jones or whatever. And so I always ask, hey, you know, how are you compensated for the work that you do? And then I guarantee you, however they're compensated is going to be that thing that they're trying to sell you. Guess what? At Steadyworth, we are compensated by selling financial education workshops and by doing our group coaching programs. And we do some one-on-one coaching as well. So we're always trying to sell education. But one thing about education is that when you're educated and you know what you can do, then you can invest in anything. So whether you want to go get life insurance, a mutual fund, a brokerage account, a retirement account, crypto, whatever it is, we want to educate you about it so that you can make the best decisions that are best for you. And we're not tied. We don't sell any products or anything like that. We want whatever's best for the client. So that's how we say neutral, because everything that we charge is connected to the education that we're selling.
Yeah.
And we educate on all types of things.
So we are at 7. We've gone an hour already. We're going to
close with the question.
Yes. If we were to close with a question, what question should we close with?
Yes.
And again, if you guys have any questions, please drop them in the chat. We would be happy to answer them.
So since we're talking about investing for a beginner, I would say, you know, maybe one thing I'll say is I'm just going to run through a couple. I have a couple ones keyed here. If nobody it throws one in the chat, but what should someone do when the market drops? Should they panic or stay put?
We learned from your other client earlier today. We learned from your other client earlier today.
Oh yeah, right.
Don't panic.
Well, I think, yeah. So I was like, you know, hey, if once again, that's why it's very important to get clear on what your investment strategy is, what your time horizon is. And so it's like, imagine if the market drops in my retirement account, am I concerned as somebody who's in their 40s and I'm retiring in my 60s, 70s, if ever? I don't know. I love doing what I do, so I may never retire. So it doesn't really matter that the market dropped, because I'm believing it's going to come back. So I think that's why it's very important to know, you know, hey, how long am I planning on being this investment? What's my time horizon? Because if you have a short time horizon, you probably should not be in the market, is my thought.
Yeah.
Probably not.
Okay.
Yeah. And so, so
don't panic.
So don't panic. I was going to see what else was one thing. What's one thing someone can do today to start their investing strategy? I think we touched on that a little bit earlier, but you know, I would say if you want to get started and you're not sure you want to put skin in the game, maybe look up some different funds you might be interested in buying. You can do that as simply if you have an iPhone or on your computer or whatever, just look some up and say, okay, I'm going to buy these funds today, but fictitiously write down how much they're saving for, and then check back with them each week, see what they're doing. That's one way that you could get started today if you're not sure that you want to have skin in the game. If you would like to get some skin in the game, you can open up a brokerage account and start investing as little as $1 a day on a platform like Robinhood. There are other platforms that allow fractional shares. I don't keep up with all of them. I mean, I'm on Fidelity, Schwab, Vanguard, Robinhood. I think that's
Coinbase.
Yeah. Then I have other platforms for like crypto, and so yeah. So I don't do every exact platform, but you know, find one that works for you. Different ones have different user interfaces, and you know, and
then you can keep it simple.
Yeah, do something that's simple. If someone is still nervous, what would you say to help them take that first step? I think I just said it. It's like, hey, maybe start with a blank account. Start with, just tracking that money just give yourself a $10,000 of fake money, and you just start tracking about how many shares that you're buying and seeing if it's going up or down. But I just want to say, one encouragement I would give about investing is start reading and learning about how government money works, the money that's in our pockets, that is, that the dollar bills, pounds, fiat currency, the way that they're able to print money. And this isn't just a US government thing, this is an all government thing. The way they're able to print money, it makes the money we have in our pocket weaker each year. So if you're not investing your money into something that's growing, you're losing money. And so that's what another thing I would say is, like, I don't want to pressure someone who feels nervous about it, but I think you should also feel nervous about working very hard and then losing money. So imagine if you saved $100,000 this year, which is an excellent accomplishment for anyone. Let's say you saved $5,000 or $2,000 or $1,000 or $500. In 2030, which is just a couple years from now, I can guarantee you that the $500 that you saved in 2025 will not have the same buying power as it did right now. That's what you should be nervous about.
Well, and one thing that I would add here is, if you're still nervous, you're probably dealing with one of three issues. You either lack confidence in yourself, you lack confidence or clarity in what process you need, what's the process in which you actually invest, or you lack the knowledge. So like usually those are the three things that create hesitation. Is you're lacking something, you're uncertain about you're uncertain about yourself executing the activities, you're uncertain about the process, or you're uncertain about the knowledge. And if any of those three resonate with you, getting clarity and getting confidence in one or all three of those areas is going to help you make the first step. So sometimes it's not really even a tactical thing. It's what information am I missing? What resources am I missing? What process steps am I missing? And if that's you, feel free to book a call with us. We'd be happy to talk through that with you and even coach you around what it is that's actually creating nervousness. Because for a lot of people, it's not really the tactical pieces, it's the mindset piece.
Yes.
It's can I really do this? I'm still feel nervous about this or that. You have some sort of belief system that is creating that level of anxiety. And so we're happy to talk through that with you. A lot of the clients that we work with, that's a part of what we do, just to help them really keep the plan and the tactical piece. We got a testimonial from one of our clients this week, and she went through our Master Your Money Challenge, which is coming. We're having another one soon. So if you're interested in that, let us know in the comments, and we'll make sure to send you the link when we have a registration page for you. But one of the things she said is, she's like, I've made plans around my money 100 times over, and it didn't stick because the mindset wasn't there. I was still working through money blocks. I still had these money blocks, and being able to move the money blocks is going to help you execute your plan. Yes. And that was one thing that she said. She was like, after the 3-day workshop, I felt so clear. I had done more work on my money blocks than I did in months and months of therapy. And now I have all the work that we did. I popped it into ChatGPT. It helped me create a plan. And now I'm executing on that plan. And I'm actually making progress on it because the money blocks aren't there. So
that could be you. Let's go.
That could be you. But yeah, I hope out of this time, you see the value and the urgency of investing. And if you have any questions at all, we'll drop a link in the chat where you can book time with us. Please leave any questions, comments, feedback in the comment section. We're doing this every Sunday for the foreseeable future, and we would love your feedback on what topics you'd like us to cover. If you like today's video, please like, subscribe, sign up for notifications so that when we drop a new video, you are the first to know about it. And Yeah, if you like our content, please drop a comment in this thing. It helps the algorithm. It helps us get
Yes.
this
And please,
content and this information out.
yeah, so please consider subscribing. We have been watching the algorithm or we get the analytics, and it says that 80% of the people who watch our content are not subscribed. We're working to grow our channel to 1,000 people this year. And so we're 20% there, a little bit over 20% there. And so we would love your help and your support.
Yes, and since we're over and I don't see any other questions in the chat, I am going to say good night.
Have a great week. Happy
Have a
Sunday.
great week, everybody. We'll see you next week.
Yes.